everyone, and welcome to the Australian Q2 Outlook with me, Josh Gilbert. Today, we're going to take you through a brief summary of what happened in Q1 2024 before looking ahead to Q2 and what we see as our 2024 investment outlook. We're going to take a look at Australia and, of course, what's impacting markets globally. But before we get started, a quick reminder that this presentation is for educational purposes only and should not be taken as investment advice, personal recommendation, or an offer of or solicitation to buy or sell any financial instruments. So, a look back to Q1. Global stock markets set new all-time highs. We had 5 record highs for the ASX 200 in the first quarter of 2024, whilst the S&P 500 took out almost 15 new high as rate cut expectations and earnings growth drove plenty of optimism. We also saw a new all-time high for Japan's Nikkei 225 after 34 years, and that was propelled by record company earnings, corporate governance reforms, and it also attracted notable investors like Warren Buffett along the way as well. So a huge start to Q1 of this year, annualizing at some huge rates. And we'll get onto that a little bit in a moment. A lot of this was led by big tech stocks. Of course, AI has continued to drive markets so far in 2024. Nvidia saw Q4 sales surge by 370%. That set the tone for 60% growth from the Magnificent Seven. We saw those numbers come through in Q1. And our latest RIB findings show that 20% of Australian retail investors plan to increase future investments in those 7 big tech stocks over the next year. So clearly the Magnificent Seven are still where investors want to park their cash, and no wonder given that huge earnings growth that we saw at the start of this year. Aussie stocks as well, such as the Goodman Group and NextDC, have been huge benefactors from the continued AI spending. Tech has been the best performing sector on the ASX 200 year to date. On the flip side of that, we've had the materials sector lagging on the back of what has been a pretty slow start to China, whereas real estate has popped on the expectation that we are going to see rate cuts. That has changed a little bit, and again, we'll touch on that in just a moment. So, as I say, materials sector, really tough start to the year. Lithium stocks have come under plenty of pressure. Lithium prices have remained in freefall to start 2024 as the question mark continues over EV demand. And I think that has been arguably justified from Tesla's recent Q1 delivery number that missed expectations, and just goes to show that it is going to be a bit of a slog for EV manufacturers, especially with rates still very high. BHP, one of the largest stocks on the local market, was down more than 12% in Q1, and that took a bit of a drag on the index, especially when we have such a large stock like that falling so heavily. And that is obviously coming from China's lackluster recovery, dragging down iron ore prices. Look, I think it's hard in the short term for investors to be bullish on names such as BHP and Rio Tinto with, so much exposure to iron ore and the persistent issues facing China's still-focused real estate and manufacturing sectors. Look, there are some signs that we may see a bit of a recovery in steel demand. The government has held off delivering the level of fiscal stimulus, that should really fully offset, the difficulty we're seeing in the housing market. But Q2 and Q3 may be set up for a slightly more positive quarters for the materials sector, however. On the other side, the real estate sector, the RBA held rates to start this year throughout Q1 and welcomed inflation remaining steady, which lifted expectations of rate cuts coming in the second half of the year. And that saw investors begin to rotate into cyclical assets such as real estate and financials, and those were the best or the top performing sectors in Q1 outside of technology stocks as well. And then finally, crypto surged with Bitcoin hitting new record highs. Bitcoin soared in Q1 on the back of the spot ETF acceptance from the SEC, one of the biggest milestones in Bitcoin's history, and it's now seeing some of the largest financial institutions in the world, such as BlackRock and Fidelity, buying up this asset by the bucket load. And it comes amid a growing trend of institutional investors wanting to get exposure to Bitcoin. We saw record inflows into the asset. It garnered over $10 billion of inflows in the first quarter of 2024. And that sort of momentum for crypto is also reflected in other crypto assets as well. So Solana gained around about 92% in Q1. And projects that were combining AI and computing applications such as the Render network also did very well, gaining 140% in Q1 as well. So just a bit of a look as well to the ASX by sector in Q1. As I mentioned, technology sort of really leading the way. I mentioned Goodman Group and NextDC, some of the two benefactors locally that are essentially jumping on the back of this AI bandwagon. Obviously, in the US, we still have NVIDIA and Super Microcomputer doing very well on the back of this trend as well. But as I mentioned, real estate also up there, financials as well. And as we can see, materials on the other side not performing as well. So we also asked you about what you expect to happen in Q2, and the results may not be too surprising. Investors are still heavily bullish on crypto as we head into the second quarter, given its Q1 performance and, as I mentioned, new record highs for Bitcoin. The US remains the focus for investors, with tech still at the top of that list as well, with a slight shift to disruptive tech that still has some catching up to do as well. Disruptive tech should benefit from the incoming rate cuts, and investors are seeing an early rotation opportunity there for this theme. And interestingly, we are seeing China come back into view for some investors. It has been a disappointment to investors over the last 12 months, but valuations are cheap, with a lot of bad news already priced in. Policy support has begun, and this should begin to help the economy. But as I mentioned earlier, risks are still there if this recovery takes longer to materialize and weakness does prolong. And unfortunately, this has been the case over the last 12 months. There's been a lot of promises, but so far they have under-delivered. So a look to some of the potential Q2 drivers and our 2024 investment outlook. On the right of the screen, you'll be able to see our asset class outlook. So we put crypto at the top. We are very bullish on crypto as we head in for the rest of the year. We have the Bitcoin halving coming up in Q2. We have potential rate cuts as a driver for that, and obviously continued ETF flows. And at the bottom there, we have cash. We believe we're going to continue to see a rotation out of cash, especially as the rate cuts come closer into our view as well. And then, of course, we have our view on the other sort of sectors and asset classes there as well. So firstly, we see a soft landing in the US, and we also see a recovery in other markets as well to support earnings. So we see Q2 being another positive quarter, but maybe not as good as Q1, where we got record highs across the board. We've got earnings season kicking off in the US, and we see that as a key catalyst. And then we're also going to be looking at rate cuts coming from global central banks at the back end of Q2, maybe looking like maybe Q3. Now, we're going to see US GDP set to ease from 3% growth down to 2%, and then it will be the reality time for rate cuts in the second quarter. But we see a global soft landing helping to drive earnings and also outside cyclical profits rebounding. More locally, we've got sticky inflation here in Australia, which may push the RBA back, but that Q2 inflation data is going to be key. The final mile on inflation is proving hard to fight. Central banks across the world are finding this difficult, from the Fed to the RBA, and that could keep the RBA on the back foot. We may see fewer rate cuts than expected, and those rate cuts may be slightly later than we expected as well. But what we believe is that rate cuts are on the way, and that will continue to reduce the appeal of cash moving forward as those rate cuts come into view, and they will push investors into other assets such as equity. Q1 inflation for Australia will be a key data point at the end of April, and unemployment will remain a focus for the RBA, especially with high migration and a recent spike in employment as well. Our view is that a rate cut is likely in September of this year, should we see data continue to move in the right direction, with another cut to follow by the end of the year. Although we saw a spike in global bond yields, including here in Australia, the view of rate cuts will continue to push back on bond yields in Q2 as well. So another sector we're going to see shifting a little bit is away from tech into cyclicals, and that should be a benefit for the ASX 200. If we're of the view of a Fed cut by July and then an RBA cut by September, we believe we will continue to see performance broaden out, with investors starting to rotate away slightly from tech into cheaper, more economically sensitive areas such as real estate, financials, and therefore Australia is full of these sectors and is set to benefit, especially into, as I say, those real estate and financial sectors. With very little exposure to tech, despite being the best performer on the local market in Q1, it hasn't given the ASX a huge boost this year. If we look at the comparison to something like the S&P 500, but with a much larger exposure to those other sectors, as I mentioned, it should create a strong tailwind for the ASX 200 in Q2 and Q3, given that we expect to see cyclicals set up for a sharp macro-driven profits rebound. So those are a couple of sectors to keep an eye on in Q2. So another area to look at is that, look, we are expecting a pullback in stocks. We believe it is slightly overdue, but it shouldn't be feared because we have plenty of cash on the sidelines. The health check on all of what we've mentioned so far is that, the market, we believe, is going to pull back. As I mentioned right at the top of this episode, we are annualizing some of the best returns for the S&P 500 in over 70 years. And typically, we see 2 to 3, 5% pullbacks a year. We haven't seen a single one yet from the S&P 500, and we've seen very little pullbacks in that time. And when we have, they have been bought. So we are going to see some weakness. But as I say, it shouldn't be feared, because we believe that we have double-digit earnings growth still in place, and we have the pillar of rate cuts on the horizon. There is also a lot of cash ready to buy. There is $7 trillion in US money market funds, and of course there is a lot of cash on the sidelines because it is obviously yielding very nicely at the moment. Therefore, if we do see a pullback, we believe that cash will be deployed. The rally has, of course, pushed those valuation levels higher. And while there is short-term risk to the downside from current levels, we do feel that assets such as equities will provide those positive returns this year, as I say, especially as we get closer to rate cuts. Patience, as always, is key when it comes to financial markets. And as mentioned, there is going to be pullbacks, and therefore that can lead to attractive entry points for investors, as we have already seen from the S&P 500 this year. When we have seen maybe a 1 to 2% pullback from the S&P 500, it has been bought up, and we believe that that will be seen again across Australian and US equities this year. So finally, from me, I just wanted to touch on the Bitcoin halving. It is an event happening in Q2, and the 4-year cycle for Bitcoin that it has followed since its inception. The Bitcoin halving reduces the mining reward and eventually caps the supply, which is creating further scarcity for Bitcoin. And what's really important to note here is, since its inception, each Bitcoin halving has been a key catalyst for the next bull market, as we can see from the table on the screen. So the blue level there that is highlighted is the year of the halving. And then the year following that, we obviously see outsized gains as well. So every year the halving has happened, we've had a positive year, and every year following the halving has also been a positive year. So although we can't take past performance as a guide to future performance, it is certainly a good way to sort of have a look at what may happen in the future, because history doesn't repeat itself, but it does often rhyme. So with the Bitcoin halving still to come, rate cuts on the cards coming maybe at the end of Q2, early Q3, and we're going to see continued inflows into ETFs as well as returning retail interest. It is very possible that we could see the peak of the bull market somewhere in the six figures. Outside of Bitcoin, Ethereum is an asset investors should also be watching, with the successful completion of the Denken upgrade back in Q1. This was another important upgrade for Ethereum, improving the scalability of the blockchain. And it actually underperformed against Bitcoin in 2023. So Ethereum is looking to catch up in 2024. We also have in Q2 the potential approval of a spot ETF for Ethereum. So that could serve as another key catalyst ahead. If it doesn't get approved, we may see some pushback in the price, but we believe that that will only be a short-term stumble. So that's it from me. Q2 looks set to be another exciting quarter, with the potential to see central banks cutting rates for the first time as they do fight that last mile on inflation. To stay up to date, though, with everything happening in the second quarter, make sure to follow eToro Australia on social channels and check out our blog for all the latest update on Australian stocks. Thanks. See you next time.